Today, we are going to understand credit spread risk and how it impacts credit value at risk, or credit VaR, in a very simple and intuitive way. Credit spread risk arises because the value of credit-sensitive instruments, such as bonds, depends on credit spreads. When credit spreads change, bond prices change, and this directly affects the risk of the portfolio. To estimate this risk, we often use historical simulation, where past credit spread changes are used to calculate a one-day 99% VaR, which can then be extended to longer periods. However, this approach has two major problems. First, credit spreads are not updated daily like market prices. Second, defaults are very rare in historical data, so models often assume no default going forward, which is not realistic. To overcome these issues, we use the CreditMetrics approach. In this method, we build a rating transition matrix that shows the probability of a bond moving from one rating to another over a given time period. Then, using historical data, we estimate how credit spreads behave for each rating category. Next, we run Monte Carlo simulations. In each simulation, a bond can either stay in the same rating, get upgraded, get downgraded, or default. For each of these outcomes, we assign appropriate credit spreads and calculate the new bond value. Repeating this process many times gives us a distribution of possible portfolio values, from which we calculate credit VaR. Now, an important aspect of credit risk is correlation. Credit events are not independent. For example, during economic downturns, many firms may get downgraded together. To capture this, we can use a Gaussian copula model, or we can assume that credit spreads across different ratings move together with high correlation. This helps us model systematic risk more accurately. Let's understand this with an example. Suppose a company holds a 3-year zero-coupon bond with a face value of $1,000. The risk-free rate is 2.5%, and the current credit spread is 150 basis points. Using this, the bond price comes out to be 1,000 divided by 1.04 raised to the power 3, which is approximately $889. Now, after 1 month, several scenarios are possible. There could be a rating upgrade with a small probability, where spreads fall significantly. There could be no change in rating, which has the highest probability, with moderate spread variations. There could be a downgrade, where spreads increase sharply. And finally, there is a small probability of default, where the bond value drops drastically, say to $300. Each of these scenarios generates different bond values. By combining all these outcomes and their probabilities, we get a distribution of possible future values of the bond. From this distribution, we calculate credit VaR. The results show that credit VaR can be quite high at extreme confidence levels, for example around $589 at above 99.9% confidence. At slightly lower confidence levels, such as between 99% and 99.467%, the VaR is much smaller, around $56.81. Finally, let's discuss two important risk management strategies. The first is the constant level of risk strategy, where the portfolio is rebalanced regularly to maintain a fixed credit rating. For example, if a bond is downgraded, it is replaced with a higher rated bond. This reduces overall risk and leads to a lower credit VaR. The second is the buy and hold strategy, where the bond is held without rebalancing. This strategy exposes the investor to larger losses in case of downgrades or defaults, even though small changes may not matter much. As a result, credit VaR tends to be higher under buy and hold. So, in conclusion, credit spread risk is a crucial component of credit VaR, and models like CreditMetrics help us capture rating changes, default risk, and correlations more realistically. Also, the choice of strategy plays a big role in determining the level of risk in the portfolio.